As we head deeper into 2026, the U.S. Federal Reserve may be facing one of its most pivotal years in decades. My next guest says central banking, as we've come to know it, could be coming to an end, and be giving way to a far more politically constrained institution. And the stakes for markets are high. Joining us now to break it all down is Kevin Hebner, Managing Director and Global Investment Strategist at TD Epoch. Kevin, great to have you back on the show.
Hey, Greg.
Let's talk about this intriguing idea, 2026 being a true turning point for the Federal Reserve. Why more so than in other years?
So it's really about the imperial presidency of Trump. And so, as you know, Trump is not a big fan of checks and balances, and he's breaking lots of norms. And so this affects his relationship with Congress. So he's dominating Congress. Last year was a record high in terms of the number of executive orders passed, record low for pieces of legislation. With the Supreme Court, you now have a majority of the court is aligned with Trump. Most government agencies now, Trump is in control of. Fed is sort of the last man standing. And we're seeing with the Dunroe Doctrine in the Western Hemisphere, Trump wants to have dominance in that reign. So it's really about dominance of this person, everything being aligned with Trump's economic and security agenda. And the Fed is pretty key to that. So yes, I think this is a key year for the Fed. And it certainly looks like Trump will be having his way that around May we'll see a clear majority of Fed governors being aligned with Trump's agenda.
All right, so we have this push and the Fed independence is being actively tested. Why is this such a central issue for the president?
So it's important because the Fed has lots of levers. And historically, the Fed has just had responsibility for short-term interest rates. And that's been pretty important. But we've seen over the last 25 years or so, with the global financial crisis with COVID, is that the policy levers of the Fed has widened a lot, so-called mission creep, particularly when Ben Bernanke was chair of the Fed. So they went from short-term interest rates, zero interest rate policies, ZIRP, to quantitative easing. The size of the Fed's balance sheet went up 5x. The Fed set up all sorts of special purpose vehicles, typically to help out, sometimes bail out, financial companies, insurance companies, and so forth, helping Wall Street, not helping Main Street so much. And then also a lot of dollar swaps that they offer to other central banks in a crisis when countries outside the U.S., this would include Canada, either need U.S. dollars to import, say, essential emergency goods into the country during a crisis, or they have U.S. dollar debt that they need to roll over and funding markets have frozen up. So the Fed's remit has expanded enormously over the last 25 years through a series of crises. And many of these areas are inherently political. How do we help our allies? How do we transfer wealth between Wall Street and Main Street? And so much beyond the historical remit that the Fed has had sort of since 1913, very much focused on narrow short-term interest rates.
So this idea of mission creep at the Fed, and you're saying some of this mission becomes political, does this leave them vulnerable to this kind of attack on their independence?
I think a lot of it does make them vulnerable because, certainly affecting short-term interest rates, and that is a political act. And we have seen, even within Fed members, like Democratic members of the Fed will tend to be more dovish when there's a Democratic president and vice versa, and similar with Republican. So that's political. But once you start to get into quantitative easing, a massive balance sheet, special purpose vehicles, and dollar swaps with other countries, these are all very political decisions. And you have these made by unelected, unaccountable, so-called bureaucrats, but many of them are political themselves. The chair before Powell, Janet Yellen, she's a fantastic economist, but she was also Treasury Secretary for Biden. She's a very political person. So these things are inherently political, and the White House is very concerned that you have these very political decisions. The vast majority of Fed staffers donate to the Democratic Party, not to the Republican Party, that these things have become highly politicized and that they should, as a consequence, be reporting into the White House, not being independent.
So in that sense, I mean, some people might be saying the mission creep justifies, the Fed losing some of its independence. But under that scenario, I don't hear them losing any of that mission that they've creeped into. It'll just simply be redirected with a straight line of saying, this is what we want you to do. Yeah,
and I think that the idea is to reinvent the Fed a little bit. So the Fed is more focused just on short-term interest rates. The bank supervisory role of the Fed, which has existed since 1913, but became much more important in 2010 after the global financial crisis, that should go, say, back to the Treasury.
Oh, so there would be some changes. There would be someone pulling back on their
I think a lot of changes are envisioned to have a narrower, more focused Fed on these issues in the other functions that the Fed has taken upon themselves over the last 25 years, that those should go to the Treasury or the FDIC or other aspects of the government.
Okay, so that's great backdrop and great stuff to think about in terms of what the Fed might actually get up to this year. I mean, the market's right now pricing out about 2 rate cuts.
Yeah.
If we do get a Fed that's perhaps more sympathetic to the current administration, doesn't that seem like a little low of a number?
Yeah, I think we're seeing more than 2 cuts. And the base case view is GDP growth is 2% plus or minus. Core PCE inflation, currently around 3, goes down to about 2.5. So you have an environment which is conducive to the Fed cutting. I think in May, when we get a majority of Fed governors are aligned with Trump, and actually I think around May we get a 5th governor resigning and then replaced by a Republican, then I think you have a supermajority of Fed governors aligned with Trump. And I think they could make the case that the Fed's fund rate should be below 3%. And so I think we could get 3 or 4 cuts rather than the 2 cuts that the market has priced in.
Is 3 or 4 cuts going to be constructive for the U.S. economy? Could there be any problems with a more aggressive rate cutting path?
Well, it certainly means a lot of liquidity, and liquidity is super important to risk assets. At the same time, what's going on in bank supervision, so the person responsible for bank supervision in terms of the Fed governor, it's Michelle Bowman. She's a Republican, so any policy she wants to put in place has to be approved by a majority of Fed governors. So that becomes a lot easier from May. So I think we'll see policies from the Fed easing capital requirements and more encouraging policies to have banks lend more. So I think we get more bank lending, we get lower policy rates, and I think we also get a lower US dollar. That's a bit more complex, but you have 3 sources of liquidity, I think, as a nice tailwind for risk assets and equities this year.
In terms of who's going to be in that Fed chair when it's no longer Chair Powell, does the market have a favorite? Is there someone now who looks like they're in the lead?
Yeah, so prediction markets are trading very actively on this. So right now there's about a 50% probability on Kevin Warsh, and he's been in previous Republican administrations. 25% probability on Rick Ryder, who's currently head of fixed income at BlackRock, and then another 10% or so on Kevin Hassett, who's currently in the White House.
I think he was just told by his boss, though, they like him where he is. I've been in those positions before where I wanted a different job. They said, we like you where you are. We like you where you are, Greg.
Yes, you don't want to be so good that you can't get promoted. But we'll probably know in a week's time, something like that, because it does take some time to get the person through Senate, and they have to be approved by the Senate to get in the job and to get markets ready for it. But I think rather than the person, it's important to focus on what are Trump's 2 key criteria for whoever gets the position. The first one is loyalty. And loyalty is super important for Trump because in Trump, his first term, there are many cases in which he appointed people who looked great on paper, had good meetings with them, but there wasn't a lot of loyalty. And for example, his trade rep, Robert Lighthizer, fit that bill. And so Trump, first of all, wants someone who's loyal. And certainly Warsh and Hassett fit that bill. It's not so clear about Ryder. The second criteria is competency and how they're viewed by the street. In particular, the Treasury Secretary, Scott Bessent, he has a long Rolodex. He was a hedge fund manager for decades. And so he will call up his friends in the street and make sure that whoever ends up getting the nomination is someone the street liked, because Bessent, managing the $36 trillion of treasuries at the Fed, and Trump, as well as mortgage securities, everything, they don't want the yield curve moving up, mortgage spreads moving up, and so forth. So those are the 2 key criteria. And I think any of the 3 or 4 plus people who are being considered by the Trump and prediction markets are looking at would be totally fine.
We've been talking about the central bank and the path that it's going to be on this year once we do get that new Fed chair. More aligned with the Trump administration is the thinking here. You say the next crisis then could be much more complicated. Walk me through that.
Okay. Well, the next Fed chair will definitely be more aligned with Trump. That's a certainty. In terms of how this will make the next crisis more complicated, so we're mentioning before about U.S. dollar swaps, and so if there is a crisis, the Fed has open U.S. dollar swaps with lots of central banks globally, Bank of Canada, the ECB, and so on, because they import stuff from the U.S. and they need U.S. dollars to pay for it, and also they need to roll over U.S. dollar debt that they've issued. So in a crisis, funding markets freeze up, and you can't get this, and so the lender of last resort is the Fed. And so you can imagine that if we're in a crisis and say the ECB needs dollars, and so Trump will say, fine, we'll give you dollars, but we want Greenland. Or with Canada, if fine, we'll give you U.S. dollars, but we want rare earths. We want you doing more for Arctic defense. So it becomes transactional. And that could draw out, that could take weeks, it could take months. And so in a crisis moment, time is really important. But if you're dealing with transactions, you're negotiating with presidents, these crises could be worse. And I would expect that there will be more difficulties. Now, the central bankers of the world realize this, and they're all, in response to that, they're trying to make sure that they're less exposed to the US dollar. And so this is something we've been seeing in the last year from central banks across the world, realizing this will happen in the next crisis to try to be less dependent on US dollar funding.
Right, so the world of central banking, again, use the fact that it's not going to be the same. I know in the work that you've been doing, you've been talking about this idea that we're seeing the end of new Keynesian central banking. And plain English, I mean, I studied that stuff in university. It's been a long time for me. What does that actually mean?
So Keynes came to prominence with the Great Depression. And he argued that the Great Depression was prolonged because we try to rely on market forces to bring us out of it. And market forces didn't work. There's a liquidity trap and all the sorts of things he worked on. So he said you need really aggressive policies, including fiscal policy, but also certain monetary policies. And then Ben Bernanke, who's the one who really brought new Keynesianism into the Fed, his PhD thesis was on the Great Depression, and he studied Keynes' writing, and he looked at the monetary transmission that was responsible for the Depression, both starting and lasting so long, really until 1941 in many respects. And so Bernanke was an expert on that. And then when the global financial crisis happened, Bernanke went in with both feet. So cutting interest rates to zero, increasing the size of the Fed's balance sheet 5x, setting up all these special vehicles to fund out financial institutions that were in trouble, the US dollar swaps with central banks. He did an enormous amount of things. So a massive expansion of the responsibilities of the Fed. And this is what New Keynesian is. And in the environment we're in today, where the Fed has become so political and is involved in so many political activities, and the White House thinks a lot of this should be done by the executive because they are elected, they're accountable, whereas people at the Fed are not. So I think the type of new Keynesian that we had, both during the global financial crisis and COVID, we won't see that again. These responsibilities will be from within the White House.
Another part of your work, you got a chart for us here drawing some parallels to the era of Richard Nixon. Let's throw the chart up and walk us through it. What are we looking at here?
So the president who, in many respects, is most similar to Trump historically has been Nixon. And Nixon did lots of things, obviously Watergate, the Vietnam War, some good things, opening ties with China. But one thing he's most remembered for by economists is the increase in inflation during the 70s. And a big reason for that is he beat up the Fed chair, his name is Burns, so badly. Nixon would meet with him weekly and would be screaming at him weekly. And we can see from Burns' diary, and in the paper we have on these policies, we have a couple excerpts from Burns' diary in which he was worried that Nixon was screaming at him. He could see the veins in Nixon's forehead being extended. And ultimately, Burns was terrified and he capitulated and gave Nixon the policies he wanted. So you had monetary policy being much looser than it should be. Inflation soared. We had mortgage rates at 20% in Canada as well in the late 70s, early 80s as a consequence. And so this is what happens when you have a Fed that is making policy in response to a mercurial, emotional president. And this is the big worry, the big risk of a more Fed-aligned or more Trump-aligned or more Trump-dictated monetary policy.
Okay, we've covered a lot on the central banking front. I want to get a few more themes in there, including the U.S. midterms later this year. How important are those to the markets?
So I think there are a number of constraints on Trump, which and probably in the midterms we'll see the Senate remaining Republican. So prediction markets are saying 2/3 likely, but 75% chance the House goes Democratic. And so in that case, there could be some ballot checks on Trump's power, but the House will issue subpoenas, and Trump and the DOJ and his Attorney General will just ignore them. The real checks on Trump, one is his popularity. It's pretty low right now, and for reasons I think you understand. Secondly, his competency. He's very good at announcing things. He's not so great at getting in the weeds and actually making sure things happen. A third issue for Trump is there are some remaining checks and balances. For example, there are 3 sort of moderates at the Supreme Court, so he doesn't get his way totally with the Supreme Court. Even there's a couple people in Congress pushing back a little bit. I think the fourth constraint on Trump is just his age and his health, and we'll have to see how that happens. This is an extremely demanding job. And then I'd say the fifth constraint is the House turning Democratic in November. So it's a bit of a constraint on him, but I'd say it's number 5 in the scheme of things. And ultimately, the trend we've been seeing towards a more imperial Trump presidency, I'd expect that to continue for the next 3 years.
We've only got about a minute left. We put everything together we've been talking about, and I know it's a lot. This kind of year, is this a year of risk, opportunity, or both in the markets?
Yeah. So we're constructive on equities. So you're going to have, we think, earnings growth of 6 to 10% earnings growth. You're going to have a lot of liquidity. You have valuations in equity markets are a little bit stretched, but only moderately so. So we think there's upside, high single-digit upside for equity markets. And our key theme would be diversification away from concentrated bets in, say, the Meg 7, so big tech companies, and towards other types of companies in the U.S. and markets outside the United States.